Hi, this is the first complete comprehensive example under adjustment of capital method 2, where we calculate the capital of the new or incoming partner on the basis of the capitals of the old partners. So this example sum will demonstrate the second method of adjustment of capital at the time of admission of a partner. Let's go to the example sum. Example sum. Following is the balance sheet as at 31st March 2019 of A and B, who share profits and losses in the ratio of 3:2. To the left of the screen, we have the balance sheet given. On the right, additional information. On 1st April 2019, they admit C into partnership on the following terms. Point 1. Provision for doubtful debts would be increased by rupees 20,000. Second point. Value of land and building would be increased to rupees 1,80,000. Third point. The value of stock would be increased by rupees 40,000. Fourth point. The liability against the workmen compensation reserve is determined at rupees 20,000. Fifth point. C brought rupees 1 lakh in cash as his share of goodwill. Sixth point. C would bring in further cash as would make his capital equal to 20% of the total capital of the new firm after the above revaluation and the adjustments are carried out. We are asked to prepare revaluation account, partners' capital accounts, and the balance sheet of the firm after C's admission. So now on the sixth point, where it says C would bring in further cash as would make his capital equal to 20% of the total capital of the new firm after the above revaluation and adjustments are carried out. So this statement tells us that we have to make the adjustment of capital as per method 2, where we will calculate the capital which is brought in by the incoming partner C based on the capitals of A and B, the such capitals after all adjustments are carried out. We will begin with the revaluation account and continue with the partners' capital accounts. We will determine the capital that has to be brought in by partner C and close with the balance sheet of the new firm. So let's begin with the solution. Solution. Revaluation account. Left side debit side, right side credit side. We have particulars, rupees, particulars, rupees. The first point, provision for doubtful debts would be increased by rupees 20,000. So we have two provision for doubtful debts. ₹20,000. Second point, value of land and building would be increased to rupees 1,80,000. Book value of land and building is right now rupees 80,000. We need to increase it by rupees 1 lakh. So buy land and building account. 1 lakh rupees. Third point, the value of stock would be increased by rupees 40,000. We'll increase the value of stock. So it's by stock account 40,000 rupees. The fourth point, the liability against workmen compensation reserve is determined at rupees 20,000. There's a workmen compensation reserve of rupees 50,000 on the liability side of the balance sheet. The claim or the liability against such reserve is, as per the fourth point, only rupees 20,000. So the balance 30,000 we will distribute among A and B in their whole profit sharing ratio. The fifth point is about the premium for goodwill brought in by partner C, and the sixth point is about the adjustment of capital. So let's balance the revaluation account. Greater total on the credit side, 1,40,000 rupees. Two, gain on revaluation transferred to partners' capital accounts. A and B. Total gain 1,20,000 rupees. 1,20,000 rupees to be divided between A and B in their OPSR or whole profit sharing ratio, which is 3:2. $72,000 against partner A and 48,000 against partner B. So this is a revaluation account for this example sum. Next, let's go to the partners' capital accounts. Partners' capital accounts. Left side debit side and right side credit side. We have particulars, a column for partner A, a column for partner B and a column for partner C, and again on the credit side, particulars, a column for partner A, a column for partner B and a column for partner C. We'll begin by bringing down the balance of capital accounts for A and B. By balance brought down. The case of A, it's rupees 1 lakh. And the case of B also, it is rupees 1 lakh. Next, we'll transfer the gain on revaluation by revaluation account. As per the revaluation account, it was 72,000 for partner A and 48,000 for partner B. There's a general reserve on the liability side of the balance sheet. This has to be distributed among A and B in their OPSR. So by general reserve account, 1,50,000 in 3:2. So it's 90,000 against partner A and 60,000 against partner B. Further, we have a workman compensation reserve of rupees 50,000. As per the fourth point in the additional information, the claim is only 20,000. So we'll distribute the balance workman compensation reserve of 30,000. So by workman compensation reserve account 18,000 and 12,000. Rupees 30,000 in ratio of 3:2. Next, let's deal with the premium for goodwill which is brought in by partner C by premium for goodwill account. C brings in rupees 1 lakh in cash as his share of goodwill. There is no mention about the sacrifice or sacrificing ratio or the NPSR. So the sacrificing ratio is equal to the old ratio, which is equal to 3:2. So we have 60,000 against partner A and 40,000 against partner B. Now we need to calculate the capital which is brought in by C. You will shift the partner's capital accounts to the first half of the screen and do the working notes, the bottom half of the screen. So first working note, calculation of capital brought in by incoming partner C. Step 1, we need to get the adjusted capitals of the existing partners A and B. In the case of A, it's rupees 3,40,000 and in the case of B, it's rupees 2,60,000. Step 2 is to get the total capital of the new firm. For this, we need to apply the formulae total adjusted capitals of existing partners A and B and multiply it with reciprocal of combined new share of A and B. The total adjusted capital of A plus B is 3,40,000 plus 2,60,000 and we'll multiply it with, when we refer to the question, it says in the 6th point, C would bring in further cash as would make his capital equal to 20% of the total capital of the new firm. So if C takes 20% of the total capital of the new firm, A and B's capital should together come up to 80%, which is 100% minus 20%. So it's 80 by 100, the combined capital or share of A plus B. And to multiply with the reciprocal, we'll multiply by 100 divided by 80. We'll go back to the partners' capital accounts. 6 lakh multiplied by 10 by 8 or rupees 1,50,000 multiplied by 5, in other words rupees 7,50,000. Step 3, calculation of capital introduced by partner C. So we have the total capital of the new firm, which is the answer to step 2, 7,50,000 multiplied by C brings in 20% of total capital of the new firm. So multiplied by 20 divided by 100 or 1 by 5, which is equal to rupees 1,50,000. So this is the capital which is brought in by partner C. So we have by cash account the capital which is brought in by partner C, 1,50,000 rupees. So let's balance the partner's capital accounts. Greater total in the case of A partner is 3,40,000. The balance carried down is also 3,40,000. In the case of partner B, the greater total 2,60,000 rupees. Balance carried down is also 2,60,000 rupees. And in the case of partner C, greater total 1,50,000 rupees. Balance carried down is also rupees 1,50,000. So this is a partner's capital accounts. Next we'll prepare the balance sheet. Balance sheet as at 1st April 2019. Left side liabilities, rupees. Right side assets, rupees. We'll begin with the liability side items. Capital accounts, A, B and partner C. We'll refer to the balances of capital accounts. It's 3,40,000 for A, 2,60,000 for B and 1,50,000 for partner C. 3,40,000 for partner A, 2,60,000 for partner B and 1,50,000 for partner C. Total 7,50,000. Next item, general reserve, that's been distributed. It will not appear in the reconstituted balance sheet. The next item, workman compensation reserve, that's been replaced by the claim of rupees 20,000. So we have workman compensation claim 20,000. Final item, creditors. No change in value, 1 lakh rupees. Let's go to the asset side items. First item, plant and machinery. There is no change in value, rupees 1 lakh. Second item, land and building. Book value 80,000, but it says the value of land and building would be increased to 1,80,000. So current value is rupees 1,80,000. Debtors, original figure 1,20,000 rupees, less provision for doubtful debts. Existing provision is 10,000. As per the first point, the provision for doubtful debts would be increased by rupees 20,000. So right now the provision is 30,000 rupees. On deducting the outer column, we get 90,000 rupees. Stock, book value is 1,20,000 rupees. It says the value of stock would be increased by rupees 40,000. So current value of stock is 1,60,000 rupees. Cash, opening balance 90,000. As per our working note, the capital which is brought in by partner C is 1,50,000 rupees. Plus the premium for goodwill which is brought in by C is rupees 1 lakh. Totally 3,40,000 rupees. So all the items are over. Let's tally the balance sheet. Liability side total 8,70,000. Asset side total is also 8,70,000. So this is the balance sheet. I'll remove the split and we can view the other account as well. We began with the revaluation account. We got a profit or a gain of rupees 1,20,000, which we divided between A and B in old profit sharing ratio 3:2. Then we prepared the partners' capital accounts, and with the help of the adjusted capitals of A and B, we were able to determine the capital which is brought in by the incoming partner C. Next was the balance sheet. Both sides tally with 8,70,000 rupees. Followed by the working notes to calculate the capital which is brought in by the incoming partner C. Step 1 was to determine the adjusted capitals of A and B. Step 2 was to take the total adjusted capitals of A and B and multiply it by the reciprocal of the combined new share of A and B. And step 3 was to calculate the capital introduced by C by taking the answer of step 2 into the share of capital of C in the new firm, which is 20%.